Hey everybody, this is Sean with Not Financial Advice. Today is Wednesday, May 1st, and on today's video, we're going to be talking about how anyone can beat the stock market by listening to Buffett's wisdom. And in today's video, there was a couple different angles I was thinking about coming to you from. One would be a video made to myself 3.5 years ago, kind of a what would I do different video. Another angle of what I'm wanting to share are some of the different metrics that I look at when picking stocks and how that's been inspired by Buffett. But at the end of the day, the video is about how the average Joe can beat Wall Street, beat the S&P 500 by applying some very simple principles learned by Buffett. I'm going to break all of that down and show you what we can all do differently in the future to have better investment results. Stay tuned. We're going to get into it right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, so we're sitting here Wednesday, May 1st, 2024. Portfolio is at $75,900. In the last 3.5 years, I've made some money. I could have made more, I could have made less, but as things stand, I'm fairly happy. And a lot of the things that Buffett teaches, can be applied towards our investment decisions. So let's just get into it. I'll ask you to like the video, subscribe to the channel, but let's just start by looking at some words of wisdom from Warren Buffett. So, number one, don't bet against America. The majority of his investments are in the United States. I think there's a few reasons for that. A lot of the technology that changes the way the world works comes from America. We're in a very secure position with two oceans between us and any potential adversaries. And we have a generally good, solid form of government. So that's number one. And, number two is only buy things that you understand. I've tried to live by that, but it can definitely be tempting at times to go after that high flying stock. But the reason that you buy something that you understand is because when the market goes down, you aren't going to sell something at a loss because what its value is. And, that goes into the next point, which is buy companies that have a moat. He's described that as a company or a great business is one that you would walk across the street for. And so, he gives an example of the Snickers bar. If you go to a drugstore and they have drugstore brand caramel and nut bar, you might walk across the street for a Snickers bar. And so that's a definition of a company that has a moat, but those companies with moats also have pricing power. And that ties into the metrics we're going to be looking at. He also talks about concentration. It's okay if you know what you're doing. And so, um, well, I think he just personally owns Berkshire Hathaway. Berkshire Hathaway now owns about 45 stocks, and in his wife's will, she owns the S&P 500. So he talks about how index funds are also great. If you don't have the interest level to analyze companies, it's hard to beat a good index fund, and so we're going to talk about that. And lastly, he will say that it's okay to pay a little bit more for a great company. I guess one that I would add here would be number 7, which is number 7 says that the market is right most of the time. And so market inefficiency. And so let's jump over to the next page here and see an article that we found from just about 3 years ago exactly. So it was on Yahoo Finance from a group called Guru Finance. Microsoft stock appears to be significantly overvalued. I was curious about that. So it ties into some of these principles we just talked about. But if you look here, we can see that the shares are up about 57% since that article boldly proclaimed that the stock was overvalued. And that ties into this concept. It's okay to pay a little bit more for a great business. So let's see this in practice. Now, what I've done here is I've made a new sort of spreadsheet here that covers all of my stocks, but I've just started with all of my stocks that I feel have a wide moat and are non-cyclical. Cyclical stocks would be like a fireworks stand on the 4th of July. The opposite of that would be a hospital, for instance. And so these wide moat stocks, it's been described by other people as companies that'll certainly be around in 20 years. So I just created a universe here, and I wanted to share some of these different metrics that I look at when I'm analyzing stocks that are informed by Buffett and others. So number one, first and foremost, is top line revenue growth. And so I've actually rated all of these companies here by their top line revenue growth year on year over the last five. And so we have Salesforce, Meta, Google, Microsoft, Costco, Ulta Beauty, and Visa all around 10 to 20%. Okay, and you can see the rest of these names that we have here: Dollar General, Berkshire Hathaway, Pepsi, Waste Management, Mexican Coca-Cola, American Coca-Cola, Tyson Foods, Kroger's, Procter and Gamble, Johnson and Johnson. And then these are some of the other metrics that I use when I'm screening stocks over on Qualtrim. So we have the 5-year free cash flow growth. And so when we look at that, let's sort that A to Z. Z to A rather, and let's see which of these companies, the top five, have the best free cash flow growth. And so you have Salesforce, Mexican Coke, Kroger, Costco, and Google. So another metric that I look at, and this is inspired by Buffett, is if the company is diluting shareholders or if they buy shares back. And so the top five that we have here are Ulta Beauty, Dollar General, Berkshire Hathaway, Kroger, and Visa, all buying around 2.5% of their shares back every year, year on year for the last five. Now, another thing that Buffett often talks about and teaches about is returns on capital. And there's a bunch of different ways to measure this. This particular method, the data I have access to, is returns on capital employed. Anything above 20% is exceptional, but the top companies we have here for that are going to be Ulta Beauty, Visa, Microsoft, Google, and Meta or Facebook. And so that means if you give them $100 to buy stock, what percent of that can they convert into profit? So it's about the efficiency of the business. We want to see if the returns on capital are going up or down. We also want to take a look at things like profit margin. I like to look at the very bottom line profit margin after everything's all said and done. What is their net margin? And so looking at that, we can see some familiar names showing themselves here. So Visa, Johnson and Johnson, Microsoft, Meta, and Google would be the top five. We also should see whether that trend is improving, staying the same, or going down. But lastly, nearly lastly, is going to be sort of cash to debt. And so it's been said that it's hard for a company with more cash than debt to go bankrupt. Not impossible, but hard. But this is certainly something Buffett looks at. And so, different companies that have more cash than debt, it's going to be companies like Berkshire, Microsoft, Meta, Google, Salesforce, Ulta Beauty, Costco, Kroger, so on and so forth. Now, there's different ways that a stock price can go up and down. One of them is by having better than expected top line growth or free cash flow. Another way that stocks can go up or down is with a catalyst if they develop a new product. But additionally, some of the value is shown to shareholders not only in buybacks, which you see here, share count, shares being bought back can be a price catalyst, but the security and the growth of their dividend can also be a catalyst when it comes to the price of stocks. A dividend just makes a stock a little bit more bond-like to give you more of that visibility and that tangible faith in their ability to profit you as a shareholder. And so we have some other metrics here like payout ratio. Generally, you like to see that around 50% or less. But you can also see market cap. Generally, the bigger, the better, or the bigger they are, the less likely they are to go bankrupt. And the reason that I've scanned for, companies being cyclical, there's things that Buffett does that we can't do, which is analyze insurance companies most likely. And so I've just created this universe, right? And we're going to sort of back test it. I'll ask you to like the video, subscribe to the channel, and let's sort of see what type of results we came up with, keeping in mind that there are a rule for index funds or ETFs, and that can be 100% into index funds if you're 100% ignorant of how to analyze a company. But if you're newer or you're not quite sure, you might choose to go one for one. You might put $100 in an index fund and then $100 into a basket of stocks. And that's, certainly what I wish I would have been able to send this message back in time to teach myself. And so what we've done here is we've gone ahead and we've looked at those various screens, and I've sort of created a universe here: 1, 2, 3, 4, 5, 6, 7, a universe of 7 stocks that kept on coming up repeatedly for revenue growth, free cash flow growth, shares going down, returns on capital, net margins, and more cash than debt. And I've come up with this universe of 7 stocks, right? And so what I wanted to do is back test them and see if we can apply Buffett's principles and have better than average results in the market. So we're over here on back test, portfolio visualizer, a back testing piece of software. We've gone back as far as we can up until today's date, and we contributed $1,000 initially with $1,000 each year. We've not rebalanced this investment. Uh, we've also reinvested dividends, and we're benchmarking this against the S&P 500. And so these 7 companies that did the best across all of my metric screens, what we can see here: Microsoft, Salesforce, Costco, Meta, Google, Visa, Ulta Beauty. We've put those about 14.3%. And then I've also done a back test going back to, I believe it was um, January of 2013, of just the total world stock market. So that's about 65% US stocks, 35% international. So let's take a look firstly at how the results were for those that 7 stock basket that scored high on all those metrics. So we can see that portfolio here. What we can see is that portfolio number 1, which is in blue, outperformed all other portfolios. Portfolio number 1 returned 23.6% a year over the last 11 plus years. Now, portfolio 2, which is the total world stock market, that did less well at 9.9%. And the total US stock market, or the S&P 500 rather, returned about 14.3%. And so the reason I like the Vanguard Total Stock Market ETF, the majority of it is US stocks, but there have been whole decades in the last 40, 50, 60, 70 years, whole decades where it was international stocks that performed with positive returns, where US stocks were either flat or down. And so, there can be periods of time when international stocks outperform, but all that we're doing here, you guys, is overweighting US stocks against the total international market. And so when we take these 2 numbers here, say we went 50% into a portfolio of carefully selected stocks, a concentrated portfolio, and then 50% into the total US market, the S&P 500 over these last 11 or so years returned 14.3%, but the blended average of these stocks would be about 17 or 16.7 rather. And so it's just a few percentage points. How much of a difference can that actually make? Well, I've set out to answer that question and just sort of show you looking at NerdWallet's investment return calculator. So you can see here, if you invested $1,000 initially with 500 as a monthly contribution over 20 years at the rate of the US stock market, 14.3% over the last 11 and a half years, you'd end up in 20 years with 850,000, a life-changing amount of money. But what's the difference between 14.3% and 16.7%? Keep in mind, this is only taking half of your money and putting them in individually selected stocks, carefully selected stocks, leaving the other half of your money in the total US market. You'd be able to do 16.73%. That would leave you at 1.23 million, a significantly higher amount of money. So if I could send this video back in time to myself, I would have done that. Instead, I've made it for you. If you got value out of today's video, leave a comment below. Make sure to like and subscribe. I'm Sean, not financial advice. See you on the next one.